what's interesting here, if we take a look at these most recent attacks and even the attacks by Israel, we're still about 10-11% off the 2025 highs. So it seems as though that the strategy that's being undertaken here of late is to sell into these geopolitical rallies.
And we've seen the probabilities for a closure of the strait climbing, but we still think that's really a break glass scenario for Iran. That would bring the weight of the world and maybe more importantly, the U.S. Navy down on them to reopen that strait, as nearly a quarter of global oil transits through the Strait of Hormuz every day.
And everybody in the market is trying to assign a probability to that and price that in. And we think now there will be an additional geopolitical risk premium. But as you said earlier, what we've seen in the market this morning is that Brent oil spiked to higher than $80 a barrel, but then paired those gains, which tells me that the market interpretation of the current situation is that maybe there will not be a significant retaliation by Iran.
Part of it is also why they're remaining elevated. And I think like what you need to see to the latter point is some more fundamental support and less of it attributable to the geopolitical risk premium, right? Like I think as long as folks believe the increase in prices is temporary, they're not likely to change much behavior.
So since the escalation started roughly a week ago, so we're talking about June 13th, that was the big day. European gas prices have surged 20%. They opened today at more than 42 euros per megawatt hour, and since have settled at around 41.
And really, this whole thing just reinforces supply diversity. This isn't the first event that's happened in the Middle East. It happens frequently, and the question becomes Strait of Hormuz, all of that capacity, about a fifth of global capacity comes from Qatar and UAE. What would happen? So, it really just helps the US if they cut it off. If not, prices go up because the US, most of it is contracted, right? But it's technically spot because most of the contracts are with portfolio aggregators or traders. So it's destination flexible. So the higher prices help the US suppliers and also those companies that have contracts with them.
Good morning, good afternoon, everyone. This is Rob Barnett from Bloomberg Intelligence, and I would like to welcome you to today's energy research call. This is the second one here in just a couple of weeks off our normal schedule, where we've felt compelled to put something together to respond to rapidly evolving geopolitical events. So on the call today, we've assembled essentially the entire energy-focused team from BI, or at least most of us. And so just quickly on the call today, first we've got Salih Ilmaz, normally calling in from Dubai, but happens to be in Cyprus right now. So hey, Salih. Swinging over to London, we've got Will Hares joining, then popping down to Madrid. We've got Patricio Alvarez. And then swinging across the pond up in our New York City office, we've got Scott Levine, then Vince Piazza, and Talon Custer. So that's the crew for today. So please drop any questions you have into the chat, and we will try to address them time being available. But so for just some framing, I'm just looking at the screen right now. Brent Crude's really mid-70s, $77 a barrel and change here at the moment. So Will, let's come to you first. Give us your read on what happened, perhaps where we go from here. Are we in a worst case scenario yet?
Yeah, thanks, Rob. I think it's really too early to say, but I think looking at the next 24 to 48 hours will be critical. This is the period that Iran has said they will retaliate against U.S. assets within the region. So it's going to be very dependent on the nature, the target, the scale of retaliation that we're going to see from Iran. Is it going to be on U.S. service members? Is it going to be on disruption of marine traffic in the Gulf and the Strait of Hormuz? Could it be on regional energy infrastructure like we saw in Al Abqaiq back in 2019? So there is really a wide range of possibilities here. I think what we can say at the moment is that the oil market has been incredibly resilient to, to the highest level of geopolitical risk that we've seen in a very, very long time in the Middle East. And I think what we can take away from that is that we're going to need to see actual tangible evidence of supply disruption, I think, for oil to make a serious move, well into the 80s or even north of that to 100. And so that could be, the scenario of mining of the Strait of Hormuz, which would be an extreme outcome, we think, and we've seen the probabilities for a closure of the strait climbing, but we still think that's really a break glass scenario for Iran. That would bring the weight of the world and maybe more importantly the U.S. Navy down on them to reopen that strait, as nearly a quarter of global oil transits through the Strait of Hormuz every day, and that would bring major economic consequences to every country in the world.
Well, I want to just follow up on that idea, because the last time we spoke, you pointed out that China is one of the primary importers of Iranian crude. So what's your sense on their engagement on this matter? Do you think that their sort of existing role within the market perhaps is one of the factors that helps keep the Strait of Hormuz open?
Yeah, absolutely. So Iran exports nearly all of its oil and products through Karg Island, which is in the Persian Gulf, and through the Strait of Hormuz, and almost all of this goes to China. So you can imagine that they will be in the Iranians' ear with a very clear message of de-escalation, and that's our main base case scenario here. Iran has to respond. They have to respond to save face internally, we think, and to play it internally via media, and for the ultimate strength of the regime to prevent a full collapse. But we do expect them to, as they have in the past, to be relatively restrained, because if they do, hit U.S. service members, then I think we're definitely looking at a potentially retaliatory spiral here. The U.S. would have to respond if any U.S. service members are killed by retaliation, and then I think we're probably in a new era of geopolitical risk there for the region.
Fantastic. Okay, thank you, Will. Salih, let's get your perspective on the matter. You've got some notes out really looking at some of the upside cases. So, walk us through, Will already laid out sort of the base case there, but walk us through some of the scenarios where oil moves a lot higher, and what are the catalysts and signposts you're watching that could potentially move us into, much higher pricing?
Sure. So, I mean, we have lifted our base case now slightly higher to the $80 to $90 a barrel range. I mean, we were already talking about a roughly $10 a barrel geopolitical risk premium on prices. That's around the amount of increase we saw since the first attacks a couple of weeks ago. And now we think that, I mean, of course, we don't know what comes next, what type of retaliation Iran will do. And everybody in the market is trying to assign a probability to that and price that in. And we think now there will be an additional geopolitical risk premium. But as you said earlier, what we've seen in the market this morning is that Brent oil spiked to higher than $80 a barrel, but then paired those gains, which tells me that the market interpretation of the current situation is that maybe there will not be a significant retaliation by Iran, but of course, we really don't know. And I think there are several options for Iran, as Will pointed out. But beyond that base case, I mean, I am watching two main scenarios right now. And one is a potential retaliation by Iran that targets some of the oil infrastructure in the Gulf. That would be similar to what we saw in the Abqaiq oil facility attacks back in 2019. I mean, that instance did take about 5 million barrels per day of Saudi Arabia's production temporarily, but nonetheless. And I mean, of course, to put that into context, that's about 5% of global oil supply. So if we do see a retaliation that includes that type of attacks, either in Saudi Arabia or in the UAE or in Iraq, that's one scenario to watch out, where we would see a much sharper increase in oil prices. And as Will pointed out, the most extreme case scenario would be the closure of Strait of Hormuz. I mean, this is logistically difficult to do. And of course, as Will pointed out, it would almost certainly bring the US Navy into the picture. And as again, Will pointed out, this wouldn't really be beneficial for Iran either, because its own oil exports go through here, and then they're almost all of them are going to China. So China would be very against this, partly because they would be losing that 1.6 million barrels per day of imports that they have, but also they would be hurt from the much higher oil prices. So those are the three main cases, and perhaps finally a fourth one that may be being underreported and not being talked about much is if, and that's a big if, there is an off-ramp here and there is a potential de-escalation. Also seems quite unlikely at the moment. But if there is one, then there is a scenario where we do go back down to mid to low 60s, where we go back to talking about how there is likely to be a surplus in the oil market, and the fundamentals are skewing the price risk very much to the downside. So that's the fourth one that we're watching. But the framework currently for us is broken down into those four main scenarios.
Okay, very, very interesting. Vince, let's bring you into the conversation. So Solly just laid out a very interesting set of conditions. So we've got a fundamental outlook that's quite a bit more bearish, but then we've got all these geopolitical factors. So how do you think about this from the perspective of the U.S. oil patch? You know, are E&Ps here in the States going to play this? And, you know, what's your read into how it affects them?
I think near term, it does not impact them from a change in budgetary constraints that investors have placed on them. I think any geopolitical risk premium is something to hedge into. In other words, rather than take a structural perspective on any shift in fundamentals, it's an opportunity to ratchet up maybe some hedging strategies around that in the near term. More broadly, the investor base is still suggesting to them and quite adamantly that we do not want to see production growth, and that returning of excess cash is the mantra, whether it be via dividend or incremental share repurchases to buy back any dilution from M&A. So I think that's the real focus. What's interesting here, if we take a look at these most recent attacks and even the attacks by Israel, we're still about 10-11% off the 2025 highs. So it seems as though that the strategy that's being undertaken here of late is to sell into these geopolitical rallies. And I think, as was mentioned by Will and also by Saleh, unless you see a true impact on capacity, this is probably not a sustained price appreciation. Delays in transiting certain waterways, they may have a modest incremental impact on the price, but I mean, differentials are still tight here. You're still running right around $3 Brent versus WTI. So things seem to be fairly well contained. And I think in the near term, any M&A that was being talked about is probably off the table, just given how much more clouded the events are. But this too shall pass.
And so I want to follow up just quickly on the strategy of the E&Ps. 6 months ago, I think everyone was worried about this oversupply situation, and there was this sort of sense that prices were getting much closer to break even. So given we've seen this rally, are folks hedging, locking in those prices, or what's your sense on kind of the corporate behavior here?
Well, I think the corporate behavior here is steady as she goes. In general, the physical market is relatively tight. I happen to think that production has already peaked. We're running somewhere around 13.4 million barrels. We've been at that level for several weeks now. I think we peaked somewhere in late 2024. Most companies are still discussing maintenance programs. We really haven't seen a spike. Scott will tell you, haven't really seen a spike in rig counts or completion crews heading out there. Permits, really not a drastic change in the permitting process. So for the most part, it seems as though there is a wait and see attitude, but a more conservative approach than what we saw in prior cycles.
Okay, thanks, Vince. Scott, let's get you into the conversation since Vince just gave you a shout there. So what's your read on the situation? How long do prices have to remain elevated before you see increased drilling activity?
Yeah, thanks, Rob. So, I think part of it depends on how long they remain elevated. Part of it is also why they're remaining elevated. And I think like what you need to see to the latter point is some more fundamental support and less of it attributable to the geopolitical risk premium, right? Like I think as long as folks believe the increase in prices is temporary, they're not likely to change much behavior. For the reasons Vince mentioned. I mean, you will see incremental producers, likely the smaller guys that are independent and are more commodity price sensitive, ratchet up activity, for obvious reasons, and they'll do it likely in the more the basins with higher break evens, right, where they can make a quick buck. But as far as the larger guys that are publicly traded and that are beholden to the public shareholders, they're not likely to change their behavior much. And so we lowered our rig count projections for year end to 550. We're still a little bit below where the rig count is right now. And we did see a small decrease in the rig count last week, which is the first week we've seen since the outbreak of the hostilities. And so our expectation is we won't see much change, but it does give us more confidence here that we will see stabilization in activity levels, and that makes sense. I think there's a lot of uncertainty in the market, and even if we don't see major activity out of Iran until this situation comes to a pass, that concern will likely still be out there. So I think we're looking at an uncertain, volatile environment for pricing, volatile within a narrow band, perhaps, however you want to define narrow. But we are not expecting this development, which certainly you could think of our rig count was underpinning 60, was assuming $60 to $65 oil. We're $10 above that in the U.S. right now, but that's largely, if not entirely, risk premium. So so long as that remains the case, we have greater conviction that we've bottomed maybe on the rig count after what was a 5% drop in the month of May. but we don't expect a major increase resulting from this, barring, call it an exceptional circumstance, call it a black swan type of event that drives the price closer to $100 a barrel or something like that.
Okay, fantastic. Thank you, Scott. By the way, for anyone who's based in London, we will be holding a roundtable there on July 10th. We'll certainly be talking about this topic and quite a few others. So if you are London-based and want to join us for that event, reach out and we'll get you the details. Okay, Patricio, let's shift a little bit away from oil for a second here and get your read on what the conflict potentially means for gas markets in Europe. We're going to start there, just looking TTFs, a little over 40 euros a megawatt hour here at the moment. So give us your read. What's the kind of worst case scenario look like there, and how's it contrast with your sort of more base fundamental outlook?
Sure, thanks, Rob. So since the escalation started roughly a week ago, so we're talking about June 13th, that was the big day. European gas prices have surged 20%. They opened today at more than 42 euros per megawatt hour, and since have settled at around 41. In terms of what the worst case scenario is, I think it's important to look at the direct reliance on LNG coming from Qatar. So Europe as a whole, so the European Union plus the United Kingdom, rely roughly on 5% of overall annualized supply from Qatar. So via LNG, that means roughly 5% of annualized demand. Although we would flag that Italy and Belgium do look relatively more exposed because a bigger share of their individual imports come from Qatar. Again, the main, I would say that, as Will and Sally also mentioned in the beginning, the closure of the Strait of Hormuz, which is the choke point for that 20% of LNG trade, which is mainly from Qatar, roughly 77 metric tons out of 85 metric tons per annum go through the choke point and are from Qatar. So the direct capacity hit would not be immense here in Europe, but given that most of those flows are Asia bound, and Europe needs to compete for spare cargoes with Asian markets, that would provoke sort of a wider supply dislocation. If you're taking out of the global market, you're taking out 85 metric tons, that's roughly 115 BCM. And that's like a third of European gas demand. And it's you would be taking off the market more than what Russia took off the European supply market in 2022, which was around 80 BCM. So it's really hard to pinpoint what the actual upside scenario would be, but we plugged in the numbers into our fair value analyzer, and we think that prices could surge comfortably above 55 euros per megawatt hour. With more intra-regional impacts for select countries that have a higher reliance, like Italy and Belgium. And on your second question, I would also flag my colleague Joao published a note on UK balancing point prices. So those are the UK's gas prices that tend to move similarly to European gas prices. And the conclusion of that note was that if the geopolitical risk premium subsides, the fundamental outlook for European gas prices is fairly bearish. We think European gas prices shouldn't be trading at 35, but should be probably trading somewhere between 30 and 35. So not ultra bearish, just a little bit bearish. And that's mainly because Asian LNG demand has been really weak this year. And there is a new wave of new LNG projects, mainly driven by the US, that are on, we expect them to come online from beginning the fourth quarter of this year. And that should really loosen the market going into 2026.
Thank you, Patricio. Talon, let's get you onto the conversation. If you don't know Talon, he's one of our LNG experts here within the BI family. So Talon, let's get your reaction to what Patricio just said, but also how do you think this conflict plays into some of the thinking around the rise of US LNG?
Yeah, I mean, I think Patricio was spot on. I agree with everything he said. And really, this whole thing just reinforces supply diversity. This isn't the first event that's happened in the Middle East. It happens frequently, and the question becomes Strait of Hormuz, all of that capacity, about a fifth of global capacity comes from Qatar and UAE. What would happen? So, it really just helps the US if they cut it off. If not, prices go up because the US, most of it is contracted, right? But it's technically spot because most of the contracts are with portfolio aggregators or traders. So it's destination flexible. So the higher prices help the US suppliers and also those companies that have contracts with them. So really it helps them, the higher prices and supply diversity may bring, some nations to the negotiating table to sign more deals for US LNG to grow even more.
Help me understand a little bit, Talon. My general sense is most US LNG is typically flows to Europe. What about the dynamics into the Asia market? Is it easy to send US cargoes there? What does it do to the economics if you have to ship to Asia versus Europe?
Yeah, and that's what Pat was saying, right? The prices would have to go up. Most of US LNG goes to Europe, but if that Middle East supply gets choked and Asia demand rises, JKM prices would go higher. It's all about the differential between JKM and TTF. The US LNG is just going to go, most of it anyway, is just going to go to the highest bidder. So if Asia prices go up and it's more economical to go there, that's where it's going to go. And then Europe has to bid it up even more. And that's why I said they are, US is a main beneficiary of all of this, all of the price volatility that drives it up. They have to compete for it. They get a higher margin on their supply, right?
Just quick sense from you, how correlated is JKM pricing to like Brent crude? Is it a pretty tightly bound relationship?
To be honest with you, I haven't followed that link closely, but I think there is some correlation, right? Because like Qatar, for example, is oil linked. Most of the LNG is oil linked, right? So the higher oil prices, that becomes more expensive. And then it's a matter of, differentiating between what JKM is, what the oil link prices are. So right now, when oil prices are 85, 90, 100, some of the other volatile events we've had in the past, it becomes a lot more expensive, of course, depending on where the other gas prices are. But I do think there is a certain link between them because of that.
Very interesting. Okay, so Sally, let's get you back into the mix here because I know you have to run in just a couple of minutes. But I'm curious to hear from you how you think OPEC Plus is going to play this. I know we talked about it on our last call, but has there been any evolution in thinking? It does seem like there is a lot of political dynamics that will play into the market. And so give us a sense, what's OPEC going to do given all of these uncertainties?
We haven't heard anything new since we last spoke last week, and that was our prediction. I think they will not change their strategy for now. And as we discussed last week as well, I think they're in a bit of a tricky situation because you could argue that they are sitting on significant amount of spare capacity, which is concentrated especially in Saudi Arabia and the UAE. So technically, if there was disruption, they would be in a place to deploy that spare capacity and fill that gap. But then the tricky part is that they would not want to be seen as benefiting from Iran's pain at Iran's expense. So I think it would be the group, but especially led by Saudi Arabia and of course the UAE, they would be very cautious in bringing that spare capacity back in. And I think another thing to note also is that back in 2018, in wake of Iranian sanctions, they did decide to bring more barrels back into the market, only to be followed by some of those exemptions that the US gave to some of the countries that bought Iranian oil, which ended up, pressuring prices lower. So I think Saudi Arabia for that reason also would be cautious in bringing those barrels back in. And one final thing I would say is that just before we went on this call, we briefly talked about the tweet that Trump had. I mean, maybe it's not a tweet, maybe it's on Truth Social, but he is in capital letters saying everyone, and I presume he is also, this is also directed mainly at OPEC, lower prices down. So I guess, I mean, it's already a tricky situation for OPEC, but then I would not be surprised if we see increased pressure from Trump for them to do go ahead and bring those barrels back in. So my expectation is that they would nonetheless be very careful, very cautious in bringing any barrels back in, because they would not want to seem to be benefiting from Iran's pain. But then there would be pressure, most likely from Trump, to do just that. So definitely one thing, definitely something to watch. But I'm not expecting OPEC Plus to change their strategy just yet.
And do you have any sense of whether the OPEC member countries have sort of a back channel to Iran to ask them, to pressure them to generally keep Hormuz open? Is that part of their dialogue at all?
I mean, I'm not sure. I don't know, but I think more than OPEC plus member nations, I suspect it was China also maybe making calls to Iran to keep those barrels flowing for the reasons that we talked about earlier.
Fantastic. Okay. Thank you, Saleh. Appreciate your comments here. Will, let's swing back around to you. We're going to run a little bit over, folks, but I want to give a little bit more time because I think we haven't explored all the angles here. So, Will, Vince gave us a sense of kind of how the U.S. E&Ps are kind of positioning or maneuvering with all of these changes in the market. Can you give us a sense of kind of, how does this play into the European integrateds and the more European pure E&Ps? And how do you think about the difference between those entities right now?
Yeah, thanks, Rob. So I think for the European integrated, this is a very welcome tailwind for them. So obviously you've got a jump in prices on both oil and gas side. As these have been pretty listless throughout the first half of the year, I think this might provide a little bit of a buffer to support some of their buyback programs for upcoming quarters. So I think it's hard to see, barring a retaliation from Iran on some of their specific facilities, it's hard to see for these countries how this is not going to be a little tailwind for them. I would echo what some of my colleagues have said about the possible transitory nature of this price tailwind, unless we see any actual supply disruption. So I would just keep that in mind, that this doesn't currently appear that sustainable, given some of the fundamentals, particularly in oil. And now on the independent European E&P front, I think these are probably some of the most highly exposed to a surge in oil pricing. They're typically quite levered. They've had heavy balance sheets, debt-laden balance sheets for a while now. So we see very high EBITDA and earnings sensitivity to any oil price moves from these companies. So you're looking at Harbor Energy, EnQuest, Aker BP. These are all relatively indebted and oil-weighted production E&Ps within the North Sea, and they've also, most of them have been struggling in the last little while, given a downward trajectory and in their production outlooks, and also a pretty poor price capture, and obviously the North Sea, particularly in the UK, is quite old. The infrastructure and costs and carbon intensity do not really compare that well to other basins, and as such, there's been sort of a flight of capital from the UK North Sea. So we've actually seen a big bounce for some of these indebted European E&Ps And I think that in the case that we do see another step change in geopolitical risk premium, this could be one of the most attractive ways to play that oil price upside scenario.
Thank you, Will. Vince, I want to get your read on this as well. So just a couple of months ago, I think we were all generally sort of on this idea that, dividends were mostly safe, but buyback programs could be at risk given where oil prices were at the time. Now that we've got this uplift, I anticipate probably many of your names are going to have a little bit better realized pricing. And so what's your sense? What are they going to do with the cash? Is it similar to what Will said? Do we see some uplift in buyback plans?
Well, I think they've been pretty clear as to how they would allocate an increase in free cash flow. So it's pretty formulaic for most. Increasing the base dividend, number one. Number two, and allocating a certain percentage of incremental free cash flow. So, for example, Diamondback has offered a guidance around anywhere between, at times, 50 to 75% of free cash flow in the form of supplemental dividends, with the also buybacks being a piece of this. Where we would like to see it spent is obviously in the M&A market, because if you have a higher currency relative to a private equity player who needs to monetize their assets, we would love to see that happen. And the incremental shares that need to be issued, those can eventually be bought back in the open market as well. It's a great way for private equity to monetize its interest, and it's a great way for the E&P to pick up potential resource scale at a fairly decent discount, just given the differential in valuation. That's the perfect case of financial engineering at its best. So A, dividend growth, B, M&A with the back end of buybacks to eradicate the dilutive impact of the share issuance.
Okay, very interesting. Patricio, I want to get your sense on how the elevated gas prices in Europe play into strategy. Is this something that's going to affect the names there? And I'm also curious, European policymakers have been so focused on reducing gas reliance following Russia, Ukraine, and then now you've got this geopolitical force playing into the market there. So, are European policymakers comfortable with the gas entities making money under these kind of conditions? And kind of what's your sense on the response to the elevated pricing?
Sure. So the first part of the question, so for I oversee European utilities, although I must note utilities in Europe are not necessarily working in the same ultra-regulated fashion as they are in the US. These are not regulated markets. So we have more IPP, so independent power producers, and they tend to trade a lot of commodities during the trading seasonal spreads and so on and so forth. So there will be a couple of companies, primarily RWE, Centrica, Uniper, which are sort of the more cyclical names or almost gas midstreamers. Part of their business is that. So those companies could benefit from increased energy price volatility, although the caveat is you would need this to be sustained over a couple of weeks at least to see some of that flow into consensus upgrades for the year. But for the rest of the peers, we're talking about the regulated utilities and integrated utilities. higher gas prices in the near term is a negative. It will be a downside because these companies have probably already sold most of their 2025 power output, and they won't be able to pass on the higher costs until probably next year, so that they can, increase consumer bills to offset this increase. So overall, I would say in the near term, it's negative to neutral for my sector. And on your second question, I think European policymakers are still, very much focused on decarbonization. The most recent news on that front is policymakers are looking to ban Russian LNG, and they're looking for a ban starting in 2028. So perhaps these geopolitical developments could make them reevaluate that decision, considering that Russian LNG still comprises more than 5% of European gas demand. So it's not negligible. We also flow in piped gas via the Turk Stream pipeline, which accounts for another 5%. So you're talking about roughly 10% reliance on Russian gas. But like Talon mentioned earlier, I think it just highlights the need for diversity. Like I don't think Europe will can force the hand and accelerate or sanction certain jurisdictions fast enough, because basically it will just be a bit short-sighted, and it will make us more exposed to these type of events.
Talon, great point to bring you into the discussion here. Are many of the U.S. LNG names geared to the commodity price at all, or are they relatively immune to these fluctuations? Give us a sense.
So, like I said earlier, most of the capacity is contracted, and they try to completely minimize exposure to commodity prices. So it's linked to Henry Hub plus a premium, and then a liquefaction fee to cover capital costs and lock in a margin, but then there's spot exposure. And, whether it's 5, 10, 15, 20%, I would say 85% is a good, rule of thumb of how much capacity is contracted for the US. Cheniere, for example, has contracted more than that. They have a higher percentage, but that small spot percentage with prices going higher, they do make a very strong margin on that. And that can be the difference of a couple $100 million for the year and push them higher to their guidance. And then you have a company like Venture Global and the Plaquemine project, which is shipping commissioning cargoes now. All of that is essentially spot. So they're making a very hefty margin on that. And the same thing for Cheniere on the Corpus Christi Stage 3. It's just smaller than Plaquemine. So they do have some exposure, but they try to steer away from it for the most part. But right now, Venture Global is definitely benefiting from that. Calcasieu Pass finally, after a few years, started commercial operations and had to, ship on the long-term contract. But the Plaquemine project is ramping up very quickly, and that's all spot.
Just last question for you. Do all of these geopolitical factors, in your mind, increase the sort of sprint to get new U.S. LNG export capacity built? Or do you think we're going to see more projects reach FID as a result of all of this?
I do. I don't want to give all of the credit to the geopolitics. I think a lot of it had to do with what was going on at home. The end of the Biden administration, Trump, he's delivered on, really assisting, the oil and gas companies. We've already seen an FID Woodside with Louisiana LNG, and I definitely see a couple more. A lot of projects have made pretty good progress with contracting. But the same thing goes for the supply diversity. Just like you don't want it all from Qatar, you also don't want it all from the US. So I do think that more projects will move forward. All of them being proposed will not be built. And, there's projects in Canada, Cedar LNG, second phase of LNG Canada, and other projects globally that could come online that will also be, good prospects for importers to diversify supply. But obviously, the US is the biggest. It's going to essentially more than double by 2030, and there is room for a couple more. I think one of the questions here becomes, typically with a project, specifically in the US, they need long-term contracts to back it all. And we've seen with Woodside, they didn't, get contracts with all of the capacity that they have. So they're trying to sign that. They've gotten a couple, but you don't want to go in and oversupply the market with spot supply, right? So you want those long-term contracts. We are seeing progress, and a lot of them have it. So that's just something to watch out for. You don't want a ton of spot supply, because the same thing with Qatar. They have projects being built and not all of it is signed. So you don't want to see a flood of unsigned capacity, and that's going to really drive prices down toward the end of the decade.
Okay, thanks, Talon. Scott, we're going to come over to you for last word here. I know a number of your energy service names. Obviously, they're active in the U.S. Oil patch, and you've kind of spoken about expectations there. Give us your read. How does all this play into some of the more internationally focused aspect of the portfolio for some of your names?
Yeah, I think fundamentally, I think the outlook for international markets is stronger than shale. And I think what we've seen from OPEC recently suggesting that if indeed they are trying to gain share at the expense of shale, that growth expectations are stronger in most overseas markets than is the case in North America, where we see things maybe peaking or even starting to decline. And, I think that, what we've seen from the Trump administration so far, despite his, advocacy for, U.S. oil and gas production, is somewhat at odds with that. At the end of the day, what's going to drive behavior is the commodity price and the fundamental commodity price, fundamental outlook. And so, all things considered, we see increased uncertainty in overseas markets. It's trumped by, no pun intended, by the price of oil. And so, our expectation continues to be that international markets in general outpace North America going forward for the foreseeable future. They may be dragged down, international is a very large basket. And so, within that, I think the Middle East still remains a strong spot for growth, including markets like Saudi and the UAE and Oman. Qatar is obviously very strong from an LNG standpoint. The Asia Pacific region, also an area of strength. Weak outliers include generally Latin America, where the outlook has become more mixed, and you have areas of weakness like Mexico and Colombia, and then Europe still. I think we're seeing weakness in Northern Europe due to economic and policy factors impacting the UK. Still been waiting forever on a recovery in Norway. So a mixed basket overall in terms of overseas markets, but generally an area of growth, I think, in the intermediate term, whereas I think North America, we can safely say, has kind of entered a period of maturity and, ultimately decline.
Okay, thanks, Scott. Just a quick reminder. So for everyone who's on this call, we have a number of ways you can access Bloomberg content. And so we've got very active chat rooms that many of you participate in. So if you are not in the BI Energy Exchange chat or the BI Future of Energy chat, reach out to any one of us. We are happy to help get you added to that. It's sort of a fun way to keep a pulse on the markets. There's a lot of active discussion on these kind of topics there. We also have numerous dashboards to help you navigate some of the data and sort of fundamental data that on this topic. So the BI OPEC dashboard comes to mind. If you've never gone there and sort of perused some of the data to help sort of think through some of these problems, I encourage you to check it out. And then last but not least, this group of us, we get together every Wednesday at 10 a.m. New York, 3 p.m. London to talk about things that are happening in the market. So, if you are interested in that and you are not a regular participant in those calls, just shoot any one of us an IB or an email, and we're happy to get you added for that distribution. And, those are not always Iran focused. It really is sort of topical, what's happening in the markets, what is some of our research focused on, that sort of thing. But please Make sure you leverage our chats, our weekly calls, and follow our research on the terminal. So look forward to being in touch, everyone. And for anyone who's going to join us again Wednesday, we'll see you then. Take care. Have a great rest of your week. Thank you for joining us.